Good afternoon. This is Tom Alexander. It is Saturday, February 4th. It's about what is it? 3:15 p.m. Eastern Time in beautiful Charleston, South Carolina. This is the weekly video addendum to the written report that you all should have received. If you are finding me on YouTube and you're not receiving a written report and you would like to receive a free written report that gives the information that shows the charts that I'm going to show you in a few minutes in a written format and a PDF you can print out. Send me an email to tom@alexandertrading.com. I'll be happy to put you on the list. Again, that's a free report. Send it out every weekend along with this video. So where are we? Well, it's been a really difficult period to read really since the beginning of the year, and the picture has begun to clear up a little bit. I think we've got a better read on what's going on, and I have a more confident perspective on the levels that I think we're looking at. So what we'll do, we'll dive right in here and look at the charts and see what's up. Okay, you can see the four primary trading indices. These are the cash indices on my screen. And everything is pretty much in lockstep. And that's something you look for in strong trends. You should have, at a minimum, three of the four primary trading indices when you are moving in a strong trend on an intermediate term basis, heading in the same direction and generally making pivot highs and pivot lows in roughly the same time frame. Now, longer term, it's still a very mixed picture because you have the Dow, and we're going to go through each of these individually. You have the Dow that has, it traded straight up into December and led the charge higher, and the others lagged to varying degrees. Well, now you've had the Dow go into a protracted balance area, protracted consolidation. Balance area is an auction market term. Consolidation, I think everybody understands what a consolidation is, and that's what we're in there. But we'll take a closer look at the Dow individually as we go through these. So let's just do this. Let's just go through these individually. We'll start with the S&P, the SPX. And this is a level that I have had highlighted in this chart for, I don't know, several weeks. And we're now trading above this trend line that held all these highs all the way back to the January high. We're above the 200-day moving average, and we've had almost a 9% rally from the close in December into Thursday's high. That's, and that's just to kick off the year. So we may have a barn burning year in the stock index, or in the stock indices, but we're not going to go higher at this rate of change. If we were to go higher at this rate of change, we would be at 8,000 in December, and that's just not likely, okay, for a lot of reasons. Now, we are also somewhat extended, and I'm going to get into the technical picture in a few minutes, but we've come up into one of the critical upper key reference areas in the indices here, and this is the SPX. Now let's take a look at the NDX. And the NDX, this is a level that I had highlighted last weekend. And basically last weekend, I said there's nothing above Friday's high until you get to this level, this 12,753 level. And that we spiked right into it, closed just above it. And then on Friday, we closed below it. We are up almost 18% in the NDX for the year. And again, we may have a rip-roaring year in the NDX, but we're not going to go higher at that rate, at this rate of change. Let's take a look at the Russell. And you can see the Russell, the only thing left in the Russell that's objective in terms of an upper quote-unquote resistance area, and I don't like the term resistance and support. I use key reference areas like support and resistance are areas that are inflection points. points, but I don't like resistance. I don't like support because the implication is, well, the market's going to turn down from resistance or it's going to turn up from support. Well, not necessarily. A lot of times your resistance areas, you'll see acceleration through them. Same thing for support. That's why I use the term key reference area as opposed to support and resistance. However, the August high could be, it is a key reference area, and it could be resistance if we do indeed trade higher directly, immediately from here in the Russell to that area. I'm going to be shocked if at this point we were to see acceleration above that level. Now, we may have stopped and formed an upper extreme prior to some balance on Thursday. We did have a little bit of a downside level, move on Friday. There's room for more upside, but I don't think you're going to see the rate of change to the upside that we saw last week. And that's sort of being confirmed by all four of the indices. Let's take a look at the Dow. Okay, the Dow was up 20% off the October low. And then since there, it has gone net nowhere. It's not down much. It's not up much from this level. It's formed a larger degree balance area. And within the larger degree balance area, it has formed this structure. This is a balance area within a larger degree balance area. Let me show you that. Now, this is where the magic market profile comes into play. Here we go. Now, I put this chart in the report, by the way, so you can get perspective. Now I'm going to unmerge this. Now, this is that balance area here. So this, what you see highlighted here, is what I'm going to show you here. Now, what you see on my screen, this is a 60-minute profile, meaning each split, each slot is a 60-minute time frame. Each profile unit is 1 day of trade. I'm using the YM for this, so it's a 24-hour session. But I'm going to show you the auction that it is. And the reason I'm showing you this is a lesson in market profile. Market profile is not magic. It's a graphing format. It's a graphing format that shows a particular perspective of trade activity. And you don't use it in a rote way. You use it to identify market condition. And it can be very good at that. It highlights trade activity on the horizontal scale as opposed to the vertical scale. And you have to understand trading price is an ongoing process of development. Now, the market profile divides sessions in a discrete manner depending on the definition that you're using. In this particular definition, we're using 1 day auctions. So each day is one auction, is one profile unit. But the bigger picture is, what is this telling us? Because if we look at this, it's pretty clear we see an incredible overlap in price going all the way back into just after Christmas. So let's take this and merge it into the auction that it is. And here you go. This is what you're trading. Here is your high volume node. And here's your upper extreme up here, and here's your lower extreme. And we closed on Friday right here. So the break of this structure above into the upper extreme or the lower extreme is the key to the break of the larger degree structure that you see here. In other words, above 34,352 or below 33,566. But this is a balance area that's formed. Now, in the indices, we have information there, and we can trade the indices a little bit differently than we can trade any other contract because of the high correlations among the four primary U.S. trading indices. And that's been one of the confounding factors really since December has been the activity of the Dow and the other three. Now, the other three are in sync. The other three are giving some signals that they're getting a bit stretched to the upside. If that's correct, it's likely that we'll see the Dow trade break to the downside out of this minor balance area and perhaps test this area. Now we'll see. Okay. Now I want to discuss the technical situation with you. And what I refer to as the technical situation, I use something that's very, very simple. I use NYSE data. And specifically, I use NYSE breadth data, the number of issues up, the number of issues down, and the net number of positive or negative issues. The red line you see on my chart in this panel right here is a 10-day moving average of advancing issues. The green is a 5-day moving average of advancing issues. And here you see NYSE closing breadth, advancing minus declining issues. The takeaway from what you're seeing right here is this is suggesting that you don't want to be pressing the upside and that we could be on the verge of something relatively significant to the downside. And when I say relative to anything that's occurred since we broke out of this balance area back in December. Now, several weeks ago, we reached an upper extreme in the 10-day moving average of breadth and the 5-day moving average of breadth that we hadn't seen in a couple of years. But I also pointed out at that time that was no reason to be shorting the market, because if we were in a strong bull leg, what you would see is higher prices and a divergence in these before anything developed to the downside. And as an example of that, I showed the 10-day moving average back on the end of last July, where we reached an extreme here and then traded 5.68% higher. Well, coincidentally, and I do think it's just coincidence, there's nothing magic to this, from this peak here in 10-day breadth, we've now not quite traded the same percentage higher as we did here. But if we were to go a little bit higher, we'd be right in that same time frame. But this gives you an idea. We could still grind higher. We could still have another thrust up into this area. But this to me is cautioning about this market just immediately ripping higher. So I am cautious heading into next week. I am looking for a short-term top. If it did not occur on Thursday, I'm looking for some short-term top that occurs next week, and then perhaps some balance. Now I want to show you another view. This is short-term breadth. Now, we use this in our live trade room. I rely on this very heavily for my futures trading. I rely on this very heavily for my options trading. I rely on this very heavily for trading leverage ETFs. I rely on this very heavily, period. The price breadth relationship is contextual, and it depends on whether we're in a bull trend or a bear trend. We've been in a bull trend. If we're still in that bull trend, if we're still in that bull leg, as of Friday's low, we should be close to another attempt at this market trading higher. Now, if we put in a short-term high, then what you're going to see is that we may see further weakness on Monday, maybe even into Tuesday, and we'll get more extreme in breadth than anything that we've seen really for a couple of months. And we are overdue for this negative 2,000 breadth reading that you see that we haven't seen. Something else is interesting. The last time we had a negative 2,000 breadth reading was way back here on December 5th. Prior to that, it was way back here on November 7th. Now, it's been 80 days and we've had one negative 2,000 breadth reading. That's the type of duration you typically get in strong bull trends. If we are in a bear market, we are so overdue for some event, and who knows what the exogenous attribution will end up being, but we are so overdue for this negative 2,000, I can't understate it. But until that occurs, we have to assume the market is going to continue along the path that it has continued. Now, and I put this in the report, there is a scenario that fits with potentially forming an important short-term top. So let's just take a hypothetical. Let's say that we're very close to a price low on Friday's low, and Monday's low doesn't go much below this level. And then we get another ramp higher that tests or exceeds Thursday, Friday high in one or more of the indices. Doesn't have to be the ES. It can be the NDX. It could be the ES. I mean the rut. And then what you would expect, if this is going to be a top, then you expect Brett to diverge yet again, so that you have something that looks like this, similar to what we had here. You can see this is the pattern that occurs over and over and over. And when you can identify the condition you're in, this can be an extraordinarily helpful relationship to keep an eye on in making your trade decisions, both on an intermediate 2-3 day term basis, as well as intraday, regardless of the instrument you're trading, where you're trading futures, options, leverage ETFs, etc. Okay, one last thing. Would be a huge help to me if you have not already, if you will subscribe to my channel, if you will like the video, and if you will make comments. All of these things help the algorithms find my channel and build it up and put it in front of more people. So that would be much appreciated. Have a great week, and I'll speak with you soon.